I'm David Hornik from August Capital. August is an early stage-ish venture fund. Early stage-ish because principally what we do is early stage investing, but we do some late stage investing. Our smallest deal in the time I've been at August for 16 years. The smallest deal we've done in the time I've been there is a $500,000 investment, pretty small, very early. The biggest deal we've done is a $130 million investment, so that's different. That one had to work. That one was $130 million out of a $350 million fund. So you can imagine if that one didn't work, we would have been in a reasonable hole. But our investors sort of said, hey, if you're foolish enough to make this investment, then go for it. Like, you know, I have investments in hundreds of firms, and if you lose $130 million in your fund, you're out of business, but I'm fine. To which we said, great, we'll do that. Which strikes me as an insane moment in time in the history of August. On the good side, that was the buyout of Seagate. And we put in 130 out of $1 billion financing. Company went private. We drove a bunch of value. My partner Dave Marquardt went on the board, and ultimately went public again, and we made $1 billion from that $130 million. That was great. So now I'm just looking for the next one. So if any of you have that, let us know. That's what I'm here for. I was given the topic of the bubble, the B word. Is it a bubble? Is it whatever? I'm perfectly happy to talk about that, but if someone has some thing that's incredibly compelling that they feel I should talk about, you can tell me now, or you can interrupt me at any time when you determine that my discussion of the bubble is a bore, and we can move on to that. I'm super happy to talk about whatever. But let me start, I will start with this question of the bubble because it hits on a lot of stuff that's happening in the industry. It hits on a lot of stuff that we're all worried about, what entrepreneurs are worried about, what venture capitalists are worried about. So, and the reality is that this idea that we're in a bubble and that it'll pop any second now is really just the anxiety of entrepreneurship in general, and it's the anxiety of venture capital in general, right? Because the way that venture capital works, as you all know, is very simple. You find a small company. Small is in the eye of the beholder. For me, small is 10 people. For a private equity fund, small is 1,000 people. And you give them money, and you hope that they get bigger, and you hope that you make more money. And there's sort of two ways that happens. And one is that you help that company build a business that's self-sustaining and ultimately continues to grow and build value, and it gets public, it stands on its own, it's independent, and is worth a ton of money. Or it gets independent, and some acquirer comes along and says, I really need some EBITDA, and it buys it, and it's worth a ton of money. That's one version. That's the great version. The other version is that you're building a company, and it is losing money, somewhere between a little bit of money and a shit ton of money, and it's marching along, and every so often you have a moment in time, and that moment in time is that point at which you must raise more money or go out of business. Because every one of these businesses that is spending more money than it is making will eventually go out of business, and the only question is how soon, right? And the only thing, it turns out, that's fatal in the world of startups and in the world of venture capital is running out of money, right? Everything else you can kind of manage through. Oh, we lost our CEO, we lost our market, we lost our heads, we lost whatever. Not all of those things are solvable. Get a new CEO, we'll find a new market, we'll build a new app. But if you run out of money, then you're done. That's it, right? And so, what I, as an investor, spend all of my time worrying about post-investing is running out of money, right? So, pre-investing is, can I find anything sufficiently compelling that I think it could be a gigantic and interesting business? And then after that, will it get liquid before it dies? Right? That's it. That's the venture business in a nutshell. Is that what you all think you're doing, either as entrepreneurs, as investors, right? Now, turns out there's a lot of things that happen in between. You know, we got to do a lot before that happens. But in the grand scheme of things, that's the challenge. So why do we all care about the bubble, that it might be a bubble? The reason we all care about it being a bubble is that if it is indeed a bubble, and that bubble bursts, that opportunity to continue to raise money for our companies as entrepreneurs or as investors is dramatically injured, right? It is much, much harder the second after that popping sound to continue to build businesses that are cash flow negative. And since the vast majority of businesses that any of you will invest in or any of you will start will be cash flow negative for some reasonable period of time, it is in our interest to pay attention to what is this a bubble, right? And the good news for those of us who are in a bubble, the good news about the bubble is that it's an awesome time to raise money. In the bubble, it's like being on a wave. Everybody gets money. Hey, everybody wins. You all, doesn't matter. Here's some money. Have extra money. Have some more money. And then you go, oh my God, I'm going to run out of money. No problem. Here's some more money. It's all good. Everybody's got money. And then when you're building your business, you're like, oh my God, it's a bubble. I should spend more money because I can raise more money, so it doesn't matter. So I was going to burn $500,000, but because it's a bubble, I'll burn $1 million, and then I'll burn $2 million. It's all right. It's all good because I can go faster because there's more money, right? Turns out that sometimes works, but it's a timing question, right? Because if you are building a business thinking that life is good because you're in the bubble, and then the bubble pops, you're fucked. Like that just it turns out it's very simple. And those of us who experienced this in 2000 have seen this happen before, right? I don't know if, who among you were in the startup world in 2000, but there are a few out there, right? It was amazing. There was nothing more intoxicating than the technology world in 1999. Everything worked. You could come up with the stupidest idea in the history of time, and you would get funded, and everyone would think you're a genius, and then you could raise more money, and then you could go public. It was amazing. Only one day, someone woke up and said, what? That's just stupid. Like, why are we doing this? And everybody said, that is stupid, and it stopped on a dime. And everybody who was building businesses, good business, bad businesses, stupid businesses, smart businesses, were caught in this incredible downturn that the market created. The gigantic sucking sound that was a public market collapsing, and then the private markets falling right in behind, right? And so anyone who lived through that experience knows that there's a little bit of a timing problem here. If you had gotten public and you had gotten liquid and blah, 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 you might have made a lot of money despite the fact that you weren't creating a long-term sustainable business. But if you got that timing wrong, you very quickly went from value to no value. There are many, many people out there who experience this sense that they were 100 millionaires, billionaires, because they have this paper money. And in the time frame that it took from them to take this latent value and get out, the market collapsed and they went from millionaires to nothingaires, right? And this is what's lying in the balance. Now, what I should say at this point, because that's all very cynical, and I'm not a cynical investor. So, what is the very best solution to bubble-itis? It's called actually building a business. Turns out, like building a great business that has good economics and makes good economic sense is a wonderful solution to bubble-itis, which is there were a bunch of companies that when the bubble burst, they looked at their business and said, I'm cash flow positive, who cares? Those were great businesses. Or, I'm creating a ton of value here. I will still be able to raise money, not at the valuation that I have been. I won't be able to go public today and all those things, but I will live to fight another day. Those businesses went on for a long time. They were creating sustainable value. In fact, I had an amazing company called Ebates that we had invested in. We invested in it in 2000, just in the nick of time for the bubble to burst. So great, this is awesome. It was an e-commerce thing where you went shut. It was the classic bubble company. It was started by two lawyers. You knew it was in the bubble when it was started by lawyers. What the fuck do lawyers know? I say this with great respect for lawyers as one, as a reformed attorney. But this was the time, right? 2000, everybody was an entrepreneur. And these two prosecutors, in between putting people in jail, were like, I got this idea. Wouldn't it be awesome if when you went and shopped online, you got some money back? And the other guy's like, yeah, that'd be awesome. We should totally do that. It'd be great to build a thing, this online shopping mall where you get money back. Let's do that. So they had this conversation. They reached out, they met some venture capitalists. They said, oh, well, that sounds like a good idea. Because again, remember, at this time, everything sounded like a good idea. And so I was like, oh, that's a good idea. It's a perfectly great idea to take these two prosecutors and give them some number of millions of dollars to go build a shopping mall where when you buy something, you get some money back. Money back shopping. Who doesn't like money back shopping? And so they built this thing, and they started getting consumers who would come to Ebates, and you'd say, oh, I'm interested in such and such thing. You'd find a site, it would say, oh, if you shop through our site, you'll get 4% back. You go, oh, I like 4% back. You'd shop there. They'd get a referral fee, and they'd give you part of that referral fee back, and it all worked great. And it was growing, it was fantastic, because it was 2000. And then we funded the company because we were like, oh, that sounds great. That could get big, it could be exciting. And then the bubble burst. And the good news for these guys is when the bubble burst, they had 12 million bucks in the bank or 14 million bucks in the bank. They had a lot of money sitting there, and they said, when we acquire a customer, they actually buy a bunch of stuff. We get paid when they buy stuff, and all we have to do is figure out how to make sure they buy enough stuff that we get paid more than it costs to acquire them, and we don't go out of business. Right? Pretty simple. And so that's what they did. They focused on that. And they grew this business, sort of bounced around, and they figured out that there was real value. I was still going to board meetings 10 years later. And 10 years later, a person who bought something in year 1 at Ebates and spent $1, in year 10 spent $1.20 on average. That's a business. Like, holy cow, what's the lifetime value of a customer? I don't know, because they never go away. They just keep spending money, in fact, more than they spent in the initial instance. Now, it wasn't an easy path. It took a bunch of time, but it turns out these very, very smart prosecutors were right. Turned out that by creating an incentive for shoppers to buy through the system, etc., would create the kind of demand that was valuable both to the consumers and to the sellers. And in 2014, the company was sold to Rakuten for $1 billion. Great! Like, that was amazing. Meantime, in 2000, there were 8,000 different companies that started just like Ebates, were trying to build a company just like Ebates, but didn't have the economic model, didn't have the business. And in 2001, they ran out of money and they went out of business. And that was that, right? So the very best solution to the bubble bursting is having a bunch of money. And the second best solution is building a business that's cash positive from that money that you have, right? All right, now, here we are in 2000 and whatever it is, 16? 2016? And so the question is, is this just a really great market and everybody's happy and it's different, right? It's different in 2016. And there are lots of arguments to say that it's different. Like, why is it different? Well, it turns out, and we all know this, it's a lot easier to build a business, right? You go to AWS and you don't have to buy a bunch of servers. You can make an app and put it on the App Store and it's easier. You can get massive distribution and it's easier. There are 1,000 ways in which it is easier to build a business today than it was in 2000. So maybe all of these unicorns, these super valuable $1 billion+ companies, are a byproduct of It's just easier, it's just better, right? That's possible, don't you think? Anyone on the side of easier? It's cheaper, takes less capital, takes less capital to build a business. So now instead of needing to raise $40 million, you can build a business in $10 million. That's the theory. I could build, what did Instagram raise in total? Not a whole lot. What did WhatsApp raise in total? Not a whole lot. Got to millions and millions of people in reach. So is this a bubble we're in? Or is it just that it's easier to build a great business? Here's the other thing. It's easier to get to gigantic markets, right? Once you've built a great product, the next best thing you can have is a gigantic market, right? There's nothing better than having a market that is billions of dollars. Because, when I fund startups, they say it's a $10 billion market. And never in the history of my investing has anyone later come back and said, I looked again, and it turns out it's a $20 billion market. It goes something like this: I have a $10 billion market. Well, it's a $7 billion. Well, it's a $4 billion market, right? So you need a gigantic market. But what's true today that wasn't really true in 2000? Well, what's true is that most of the businesses that we will fund or will be built are global. And they're global almost instantaneously, right? It's not like you say, oh, well, someday we'll build a giant sales force in Europe. Someday we'll figure out how to get European distribution or get Asian distribution or whatever. You go, click, it's on the web, it's international, right? And the scale of international is monumental now, right? You are instantaneously having access to gigantic markets. Now, those markets are easier or harder to monetize, etc. But maybe it's not a bubble. Maybe this is just really great. Maybe it's just there are lots of great businesses because bigger markets, it's easier to make a business, it's cheaper to make a business, right? Maybe that's the truth. Anyone in that camp? Raise your hand if you're in it's not a bubble because it's just better time to start a business. We got a maybe. We got a couple maybes. Well, these are like the true optimists.
Well, I'd say it's easier to build a business. What do you mean so big?
Okay, he's hedging.
No.
He's hedging. It's easier to build a business, but it may still be a bubble. It is easier to build a business, right? Now, of course, it's easier to build a business and you have big international markets, so it's all good but then you look at something like a Facebook or a YouTube or an Uber or a Airbnb or these winners, and they end up raising hundreds of millions of dollars. Uber is raising billions of dollars. So it's, efficient was great, but it turns out once it starts working, then you actually still need a ton of money to get built. Yeah, sorry.
Well, easier to start a business for you and the other guy that has the same idea, and the other, and the other, and the other.
So the fact that it's easier may actually be an incredible detriment because one Ebates in 2000 and 2016 is 5 Ebates, right? And I will tell you this: it is amazing to me how often someone will come to pitch me on an idea. Oh, here's an idea, it's going to be blah, 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 blah. And I say, that's a very clever, interesting take. And then we have my partner meeting. And here's how the partner meeting at August Capital works. At our partner meeting, we sit down and we write on the whiteboard, here are the things we met, here are the companies we met with this week, and let's talk about what they're doing and what's new, and then we'll talk about which ones we want to continue to discuss, whatever. And it is astonishing to me how often I'll put up, ebates.com and then someone else will put up rebates.org, and you'll go, all right, well, that's interesting. Well, I'll tell you about Ebates. It's blah, 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 blah. And then the other person says, well, that's rebates.org. Like, that's exactly the same model. It's exactly what they're building. And you say, well, okay. Now, why would that be the case, right? Why would that be the case? Well, the answer is that none of these companies are out of thin air. They're all a byproduct of our experiences broadly, and so we all experience the same kinds of frustrations and opportunities and whatever. And so the likelihood that an entrepreneur has some incredible moment where they discover the white space and someone else doesn't have that exact same realization based on all of the exact same inputs is really hard. It's really unlikely. Now, the tricky thing in the venture business, and I've seen this a lot, is sometimes you meet with a company and they describe something that is so smart and logical that you say, you cannot be the only one doing this. Had you not told me that, it should have been obvious. Like, why didn't anyone think of that? And then you spend your time pulling your hair out trying to find the other person doing it because it's so smart and it's so logical and it's so obvious that it's going to be an amazing business, except someone else must be doing it. And it turns out that every so often, it's just smart and obvious and no one else is doing it. And those are amazing businesses. You know, when I funded this company Splunk, it's a search engine for machine data. And when the three guys who started it called me up, we had been talking about various businesses they were thinking of. They said, I have an idea, we have the idea, why don't we come meet you? I said, that's great. They came and they met with me and they said, wouldn't it be great if you had a search engine that sat on top of your log files so that when something went wrong, you could search the log files and find the instances of that error. You could, hey, show me every instance in which this router is hit. Show me every instance in which, a call came back null set or whatever. They said, if you could do that, it would really make it a lot easier to debug systems, make your systems run better, et cetera, et cetera. And I said, yeah, that would be better. That would be amazing. Like, why does that not exist? Doesn't that exist? They're like, no, it doesn't exist. Like, why would that not exist? How do you fix systems back then? You'd go through your log files and go, for 7 hours, right? That was the process. And meanwhile, everything we do in our life to figure out some answer is to go online and look at Google. So it's like, wouldn't it be better if you could Google your log files? Yes, that would be better. Ultimately, I said, fine, it seems like it'd be better, and nobody seems to be doing it. Here's some money, and a guy named Nick Sturiali, great investor, and I gave them money and said, go build it, and they built it, and blah, 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 and, I've been on that board now for 10 years, and it's now a public company. It's gonna approach $1 billion in revenue this year, because it turns out it was a great idea, and no one else was doing it. So every so often, it just turns out to be a great idea. Figuring out which is just a great idea or there are 16 other people doing it, that's a tricky thing. And sometimes you get it wrong. And you wake up and you go, oh, whoops, that was bad. But anyway, so back to this broader question, like, okay, so how do we distinguish a bubble from a non-bubble? By the way, when do I go to?
45.
Till 45?
No, 25.
25, okay. All right. I should just let you guys ask me questions. But I'll just go through this because I do think this is an interesting question. Like, how do you know if that is the case, and we're trying to figure out, and we're all making a bunch of bets, and those bets will be importantly impacted by the question of, is this a bubble or is this just a good market? Then how do we figure out if it's a bubble, right? What is the path to figuring out if it's a bubble? So I was looking to think about it, right? So, one of the indicators in '99 that it was a bubble is that there were just too many startups. Everybody and his uncle, including a couple of prosecutors, were building businesses. And so you kind of look at it and go, it can't be the case that everybody's an entrepreneur, and yet everybody's showing up here, And so that feels sort of bubbly, right? And if you look out there on the streets, I was just walking around the city this morning, meeting with people, and everywhere you walk, there are all these people who are very clearly working in startups. You can spot them. Startup, not startup. And it went from like 1 in 7 to now 7 in 1. Like everybody in San Francisco is building a startup. So that could be an indicator that's, that it's a bubble, right? And by the way, if you lived here in 2000, there's another really good indicator, and that's called traffic. The worse the traffic, the more likely we're marching towards a bubble, because holy cow, you can't get anywhere. That can't be a good thing. Like, talk about a problem with productivity. Everywhere you go, it takes too long. I joined my venture fund in 2000. I was living out in Walnut Creek in the East Bay. My office was on Sand Hill Road. And so for the first 6 months of my commute, it was like an hour and a half or 2 each way. It was just like today. It was horrible. Anything happened on the streets, you were screwed and taking forever. By 2002, it was an easy commute, a piece of cake. By 2004, I could walk there in less time. You know, it was like awesome. You could zip through there. So maybe there are too many startups. I think here's one that I think is kind of an interesting bubbly indicator. Are there too many incubators? Right? I have to say that it's sort of amazing to me how many incubators out there. Who out here has an incubator? Right? Anyone associated with an incubator? You got a couple. There are a couple who are willing to admit that they're incubator people. I remember going to the very first demo day of Y Combinator. Right? The first class of Y Combinator had, I think, 8 or 10 entrepreneurs in total. I had to fly to Boston, hang out with Paul Graham and whatever. It was like a teeny tiny class. This year, I forget what it was, 52 companies or something was I can't even remember. But it was more than 8, I'll tell you that much. That was Y Combinator. Now we have, this is amazing to me. Did you know that the NFL has an incubator? The National Football League has an incubator. And if that was not bad enough, the Dodgers, not even the NBA, not even the MLB, the Dodgers have an incubator. You can go to the Dodgers incubator. So I just figure it's only a matter of time till there's like the Steph Curry incubator. In the off season, Steph Curry will incubate important companies. You know, that's just mouth guards and others such. So maybe that's an indicator. Like all these accelerate everybody. Who needs to be accelerated? Everyone, because everybody's starting something. So if everybody's got to be an accelerator. That can't be, that just can't be a good sign. What else? Well, I suppose one of the core indicators is there's just too much money in the system, right? There is too much money going into the system. Now, why is this a problem? Because if anyone bothers to do the math as an investor, the funds cannot. If you added up all the funds, so let me see, there was the last quarter of 2015, there were $11.3 billion. $11.3 billion went in Q4 of 2015. All right. Let us assume for a second that those firms will end up investing those in companies and owning 10% of their companies. Which is probably not a good assumption, but let's just assume we're going to put all of this money work in a range of companies. We're going to own 10% of those companies. In order for them to return that money, those companies need to be worth $110 billion at exit. That's for Q4 2015, which means that all of those companies across the year have to be worth $400 billion at exit. $400 billion at exit. Now, we have this weird problem in Silicon Valley, which is we are confused by Facebook into believing that that's a number one can achieve. Facebook's worth $300 billion. Facebook was the best venture capital investment ever. It is not the thing against which we can measure the entire industry. You cannot assume that there will be another Facebook ever, never mind that there will be another Facebook every year. And yet these numbers sort of assume that you've got to get into Facebook at 100 billion, you got to have 10 more at 10 billion, you have to have 100 more at 1 billion, and you have to have 1,000 acquisitions at $100 million. That's what you have to do to get to $400 billion in value to return the capital from 2015. Does that seem even possible? And yet nobody's doing the math. It's a fucking spreadsheet. Just do the spreadsheet. Here it is. And that's to get the money back. Then after that, you have to actually make a buck. You know? And then of that buck, you get to keep 25 cents. It's just hard to imagine that with that much money. Here's the other thing. There are too many venture firms. I say this with all due respect to my brethren in the venture business, but by 2000, there were 1,000 venture firms. Over the course of the 2000s, that number got cut in half. And now we are quietly marching back to 1,000 venture funds. Now, Again, this is a math thing. But though, to have 1,000 venture funds making money, you would have to have more outcomes than are possibly sustainable by the world economy. And in fact, if you measured the venture business, and that, again, I say this understanding full well that it's an indictment of my industry, between 2000 and 2010, every dollar that came into the venture industry was worth less than $1. A decade of you lose money if you bet on venture capital. And we're marching towards another 1,000 funds. We're marching, we have tens of billions of dollars going into the industry. So, is it a bubble? Like, I don't know. Maybe it's a bubble, maybe not. What about business model? Turns out that in the late 90s, there was not a lot of regard for business model. It was sort of like, there will be a big, giant business, and we will ultimately get paid for it. I'm always reminded there was a great Saturday Night Live sketch, and the sketch was about a bank. And the bank, all this bank did was make change. And they said, we come up with great alternatives. 4 quarters per dollar, or 2 dimes, 2 quarters, like, you know. We come up with the greatest alternatives to make you change. And then say, and people ask, how do we make money? Volume. Like, no, you don't make money in volume, making change. You lose your money. Hey, here's 2 quarters. Like, so the business model matters, and yet in bubbly times, scale matters to many people more than the economics, the immediate economics. Like, well, we could sell this thing today, and it'll cost us $10 to make, but if we get to 1 billion of them, it'll cost us $7, and then we'll break even. Okay, let me get this straight. When you sell 1 billion, then you will make no money on it. Yes, that's right. But at 7 billion, we'll make a penny. Like, that just doesn't. And in the late 90s, we lived this, where it was like, well, what's the business model? It'll work out at scale, don't worry about it. And today, we may or may not have a bunch of those businesses. My car is currently parked in a garage somewhere. Some guy came to me, picked up my car, drove it away, parked it in a parking lot, and when I'm done here, that person will bring it back to me, hand me my car, and I will say thank you very much. And I will pay less for that experience than if I just parked it in a parking garage where I am standing. I don't mean to throw stones, but it's not clear to me that that is an experience that works economically, and waiting for scale is not your answer in that regard. So maybe the answer is that the venture business has given up on worrying about business models that make sense. The last possible sign that we can look to for, is this a bubble, is, are we surrounded by knuckleheads? I don't know what that measure is, but I'm just saying, like, you could tell in the last bubble, because you look right and go, these are knuckleheads. I don't know where they came from, but they need to go back there because it's not going to go well for the industry. And then the bubble burst, and then the knuckleheads went up. So look out for too many companies, too much money, not enough focus on business models that make sense in the near term. Watch out for the knuckleheads. But the surest sign, I have to say, in the end, of that you will know it's a bubble is because you'll hear a giant pop. You will know that we've hit a bubble, and I guess I'm out of time. So we'll leave it at that.